Rising interest rates are quietly changing the way we borrow money. And if you have a loan or mortgage, you're feeling the impact more than you realize. Higher rates mean bigger monthly payments, more interest over time, and even reduced borrowing power. Many homeowners and borrowers get caught off guard thinking their finances are safe until their bills suddenly spike. In this video, we'll break down exactly how rising rates affect your loans and mortgages, and what you can do to protect yourself before it's too late. Today, we will talk about how rising interest rates are impacting your loans and mortgages. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding rising interest rates. Interest rates are one of the most powerful tools in economics, directly influencing borrowing costs, spending, and investment behavior. When central banks, like the Federal Reserve or the State Bank, raise interest rates, it becomes more expensive to borrow money. These changes affect everything from mortgages and personal loans to credit cards and business financing. Many people underestimate the long-term impact of even a small rate increase. For example, a mortgage with a 6% interest rate will cost significantly more in monthly payments compared to one at 4%, even if the loan amount remains the same. Rising interest rates also signal a broader economic shift. They are often implemented to control inflation, meaning the cost of goods and services may also rise. Borrowers who do not adjust their financial strategies during periods of rising rates risk overextending themselves, as higher monthly payments can strain household budgets. It's essential to understand both fixed-rate and variable-rate loans. While fixed-rate loans maintain a constant interest rate, variable-rate loans can increase as rates rise, making budgeting more challenging. Additionally, interest rate hikes can slow down property markets as fewer people can afford larger mortgages. Recognizing these dynamics early allows homeowners and borrowers to plan effectively, reducing financial stress and making smarter choices about refinancing, paying down debt, or prioritizing savings to buffer against increased costs. Understanding the mechanics of interest rate changes is the first step in navigating their impacts successfully. 2. Effect on mortgages. One of the most visible effects of rising interest rates is on home loans. When rates climb, monthly mortgage payments increase, especially for variable-rate mortgages. Buyers may find themselves qualifying for smaller loans than before because higher rates reduce purchasing power. This can slow housing market activity, as some potential homeowners are priced out of properties they could have afforded previously. Fixed-rate mortgages are partially insulated, but new borrowers will face higher rates compared to previous years, which can significantly increase lifetime interest payments. Current homeowners with adjustable-rate mortgages may see a sudden jump in monthly payments, creating financial strain if not anticipated. Refinancing to lock in a lower rate becomes less attractive when interest rates are high, meaning many borrowers are stuck with higher costs. Additionally, rising rates can affect home equity lines of credit, HELOCs, making them more expensive to draw from. The combination of higher mortgage payments and potential inflation in living costs can challenge budgets, forcing households to cut discretionary spending or adjust saving strategies. Understanding how rising rates affect both new and existing mortgages is crucial for homeowners to make informed decisions about paying down principal, refinancing options, or delaying new home purchases until rates stabilize. Being proactive rather than reactive can prevent financial stress and safeguard long-term wealth. 3. Personal loans and credit cards. Rising interest rates don't just impact mortgages. They also affect personal loans and credit cards. Most personal loans have fixed interest rates. But credit cards and some lines of credit often carry variable rates, which increase when market interest rates rise. This makes borrowing more expensive for everyday expenses or debt consolidation. Individuals carrying balances on credit cards may notice higher minimum payments, and paying only the minimum can result in a longer repayment period and higher total interest. Those considering new loans, such as auto loans or personal loans for education, may face stricter lending conditions or higher monthly payments, impacting affordability. Furthermore, some borrowers may become more risk-averse, delaying investments or purchases due to increased borrowing costs. Smart strategies include paying down high-interest debt as quickly as possible, consolidating debt before rates rise, or shifting to fixed-rate loans where feasible. Understanding the interaction between market interest rates and personal borrowing allows individuals to adjust repayment strategies, minimize costs, and avoid falling into a cycle of debt. With disciplined planning, rising interest rates can serve as a motivator to improve personal finances and prioritize debt reduction before borrowing becomes more expensive. 4. Impact on auto loans and vehicle financing. Rising interest rates also significantly impact auto loans. Vehicles often require financing for larger amounts, and higher rates directly increase monthly payments. For example, a 1% increase in auto loan interest over a 5-year term can add hundreds to thousands of dollars in interest costs. This may discourage potential buyers from purchasing new cars or push them toward lower-cost options. For used car buyers, higher rates can make loans less attractive, leading to slower sales and more cautious spending. Additionally, car leasing costs can rise as interest rates affect residual values and lease financing rates. People who financed vehicles with variable rate loans may suddenly find themselves paying more than expected, straining monthly budgets. It's essential to evaluate whether delaying a purchase or refinancing at a better rate later is more cost-effective than taking on an expensive loan now. Some buyers may opt to save for a larger down payment to offset increased interest, reducing the overall financial burden. Understanding the impact of interest rate changes on vehicle financing can prevent unexpected costs and encourage smarter purchasing decisions during periods of economic tightening. 5. Business loans and small enterprises interest rate increases also ripple through the business world. Small businesses relying on loans for expansion, equipment, or operational costs face higher borrowing costs, which can reduce profitability. Entrepreneurs may postpone investments or hiring due to more expensive capital, slowing business growth. For larger companies with existing debt, variable interest rates can increase interest expenses, affecting cash flow and financial stability. Rising rates can also influence consumer behavior indirectly. As individuals face higher mortgage and loan payments, they may cut discretionary spending, affecting businesses that rely on consumer demand. Business owners need to evaluate whether refinancing, locking in fixed rates, or adjusting budgets is necessary to maintain financial health. Proactive financial planning, including cash reserves and alternative financing strategies, can mitigate the negative effects of rising rates. Ignoring these shifts can lead to reduced competitiveness or even insolvency for small enterprises. 6. Refinancing challenges. Many borrowers turn to refinancing to lower payments or take advantage of better loan terms, but rising interest rates make refinancing less appealing. Homeowners who previously considered refinancing to reduce mortgage payments may find new rates higher than their current loans, eliminating potential savings. Those with adjustable rate mortgages may have limited options to lock in a low fixed rate. Similarly, personal and auto loans become costlier to refinance, reducing the incentive to consolidate debt. Timing becomes critical. Refinancing during periods of rising rates can result in higher total interest costs, even if monthly payments appear manageable. Strategic planning is essential, including evaluating long-term interest savings versus upfront refinancing costs. Borrowers should explore options such as shortening loan terms or paying extra principal instead of refinancing at higher rates. 7. Inflation, rates, and borrowing power. Rising interest rates are often implemented to curb inflation, but this interplay has nuanced effects on loans. As borrowing costs increase, disposable income decreases because households allocate more money to interest payments, leaving less for consumption or investment. Inflation can also erode the real value of fixed-rate debt, benefiting borrowers with fixed mortgages in some cases. But variable-rate loans suffer as rates rise. The combined effect of inflation and higher interest rates may force households to adjust spending, delay large purchases, or reduce discretionary expenses. Understanding this relationship allows individuals to anticipate financial pressure points and make proactive adjustments. Budgeting, emergency savings, and careful debt management become even more critical during periods of rising rates and inflation. Borrowers who fail to account for this dynamic may experience stress, over-leverage, and reduced financial flexibility. For mortgages, making additional principal payments can offset interest accumulation and shorten loan duration. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.